Well, hello everyone, it's Paul Tilley again. Welcome back to our accounting series. Today we're moving to Unit 5, and Unit 5 is all about accounting for merchandise firms and merchandise activities. And when we think about merchandise, what we're really thinking about, either at the wholesaler level or at the retailer level, is that this is a company that goes out and buys things that it will eventually turn around and sell, and it will eventually end up in the hands of the consumer. So these companies incur costs such as labor and materials to buy the inventory, and they're going to sell that and generate revenue based on it. Now, the assumption is they're going to buy it for one price and sell it for a higher price and make profit on the difference. So these products for sale are considered as inventory, and from an accounting point of view, they got to be accounted for both at a cost level and at a revenue level. So here's a basic example of the flow of inventory for a retailer. So let's assume that a linen sales associate at a major department store goes and tells her manager that a certain type of linen is in low supply. So the manager follows the store's purchasing process, and the store receives a shipment of linens from its vendor who supplies the linens. This transaction is really a purchase. So the store goes and purchases the linen, but it's not an expense because the store is going to turn around and sell that. And it will be expensed as the products are sold. So the business records the entire shipment of linens on its balance sheet as an addition to both inventory and accounts payable, because normally the products come in on some form of credit and the company will pay for them a little bit later on. So as the linens get sold to the customers, sales revenue is generated and recorded, and the costs of the goods that are being sold are also recorded, and the inventory is decreased. So say, for example, in August, the store sells linens to customers for $150. It costs the company $75 to purchase from the vendor. The sales revenue is recorded as $150, and that increases sales revenue. The cost of goods sold goes up by $75 because as the product goes out the door. And the inventory decreases by $75 because keep in mind the inventory is held at the historic original cost of the product. So matching the expense to the revenue, then, the effect to the net income is $150 in sales less $75 in costs, which equates to a $75 profit on the sale. So this chapter and this unit is all about how we account for this. We're going to describe merchandising and identify and explain the important income statement and balance sheet components for a merchandise firm. We're going to describe both perpetual and periodic inventory systems, focusing on the perpetual one. Analyze records and transactions for merchandise purchases and sales using a perpetual system. We're going to prepare adjustments for merchandise coming. And we're going to define, prepare, and use merchandise income statements. We're going to calculate gross margin and markup on inventory cost. So first, we have to consider what is the definition of inventory. So inventory is made up of materials and products a company owns for the purpose of selling to customers. So this is stuff that's owned, which we would consider an asset, but this is a unique type of stuff because it's going to be turned around and sold again at a profit. So it's often referred to in the trade as merchandise inventory, and it's classified as a current asset. And the reason it's a current asset is because the assumption is the inventory will be sold in less than one accounting cycle. If we think about merchandise activities as a general rule, a merchandiser really is a company that buys and sells merchandise products for profit. And these merchandisers can be split into two different types. There's wholesalers, which are companies that buy products from manufacturers and other wholesalers and sell them to retailers or other wholesalers, so they're like a middleman. And the retailer, which deals directly with the customer, which is a company that buys some products from manufacturers or wholesalers and sells them to the end user, the customer. So here, from an accounting point of view, then, is the flow chart for two different types of companies. A service company, which doesn't sell any hard items, or a merchandise company, which sells hard, tangible items. The service company is quite easy. Revenue minus operating expenses equals profit. It's pretty straightforward. So the company generates revenue from its activities, services, and the like, subtracts the expenses from that, and voila, you have profit. The merchandise firm is a little more technical. We got to consider our net sales. Now, net because some things get returned and these sorts of things. So effectively, net is the total value of sales after all those adjustments are made, minus the cost of those goods that are sold. And that's going to equal really what we call our gross profit, which is how much money you make on the raw product as you sell it. The gross profit then is taken, and we subtract from that operating expenses, which are keeping the lights on, heat, and these sorts of things. And that then will in turn demonstrate a profit to the firm. If we look at the income statement, how the income statement is going to look, it's going to look something like this. First of all, net sales are recorded. And from those net sales, we have something called cost of goods sold, which really is a subtractor from those net sales. That gives a gross profit from sales, which in this case is $84,300. Then we subtract off our operating expenses, $68,960, and it gives us a profit of the difference between how much money we take in and how much money we spend, $15,340. This will show up on the balance sheet. Okay, that was the income statement. On the balance sheet, you'll see that this is a classified balance sheet. We have current assets indicated. If you look at the assets there, merchandise inventory is part of current assets. And you'll see that at the end of the period, February 28th, there was $21,000 in. So we think of a merchandising firm operating on an operating cycle. And if we look at a typical firm, the cycle really begins with the purchase of merchandise and ends with the collection of cash from the sale of that merchandise. So you can see it graphically here. So the merchandiser could have cash sales, and if we think about cash sales is pretty straightforward. The cash is collected, purchases are made, the inventory is brought up, goes up for sale, cash collected, purchases are made. So this cycle continues. In the case here where we're looking at a typical merchandising company, the company uses cash to go and make purchases of inventory. That merchandise inventory is then sold on credit. This creates or generates a accounts receivable. So bills get sent out to people, the cash comes in, and effectively that's what the business thrives on, is the money that comes in eventually. That money is then used to make purchases, and again, that the inventory goes out in the form of sales, normally on credit, money comes in, and so on. The cycle continues. So when we think about merchandise inventory, we really can look at the cost side of it and say, well, what exactly are some of the costs involved? Well, obviously the cost of buying the product. Okay, that's one of the key costs. So the costs incurred in purchasing the goods are straightforward. But there are other costs that are often built in as well. If, for example, you have to pay to get the goods come to you, the shipping costs to bring them to you, those goods to bring them to you to make them ready for sale, that gets incorporated into the cost of the merchandise inventory. And generally, any other costs that are required to make the products good for distribution or good for sale are considered as all part of merchandise inventory costs. You can see the way that it flows here. If we think about merchandising cash flow, there's a beginning inventory. So there's stuff on the shelves, okay? And that stuff is available for sale. That's basically it. We also add product to those shelves as the year goes along. So we make purchases. So merchandise products are purchased during. So that fills up the shelves. So there's stuff at the beginning of the period already there. There's stuff during the period that's brought in and added to the shelf. That is sold or taken away from the shelves. So you can imagine it coming off the shelves. That's considered as cost of goods sold. And whatever's left on the shelf at the end of the period would be considered as our ending inventory. Accounting for this movement of products on and off the shelf usually is done in one of two ways. I'll start with the bottom here and work my way up. First, there's something called the periodic system. The periodic system really just involves doing a physical count at the end of the period and count how many goods are there on the shelf and calculate then how much was sold during the year, and that is reflected in cost of goods sold. So let's assume at the end of the year you count the items on the shelf. There's 100 items there. The cost of them are $10 each. So that's $1,000 worth of inventory there on the shelf. At the end of the year, we look back at the previous year to see how much was there. Well, there was $2,000 worth there. So if there was $2,000 there last year, now there's $1,000. We must have sold 1,000 units or $1,000 worth of product. The more common system that's used today, especially it's made possible because of computers and being able to track inventory as we go, is something called a perpetual system. The perpetual system provides a big advantage in that it gives you an up-to-date tally of how much value is there on the shelf. How much is there on the shelf at any given point in time? Because we record sales and the reduction of inventory as it is sold. And we record additions as it is added. So the perpetual system is really the preferred system, the one that's generally the ones that's used. So really the amount of inventory on hand is known at any moment, and we can also calculate the cost of goods sold at any moment. So here's a classic example of how a perpetual system would work, okay? So this company, for example, is in the bike business. They've gone off to the Trex company, which is in Windsor, Ontario, and they've ordered some bikes. And you'll see that there was 2 bikes ordered, and the various prices of them, the amounts, so it comes to a subtotal of $1,200. So two bikes arrive, and they're sold on credit. So we have to record them in our financials somehow or another. Well, the basic entry says with the perpetual inventory system, the cost of the merchandise bought for resale is recorded in what's called merchandise inventory. That's an account, an asset account that we record. So in this particular case, it went up by $1,200. $1,200, that's an asset, so it's debited. We recognize too that we've incurred a $1,200 accounts payable, meaning we've got a bill there for $1,200 that we need to pay at some point in time. So this is credited by $1,200. And this transaction that you see here recognizes the purchase of that bike, those bikes on credit. So to calculate the total cost of merchandise inventory purchases, we must adjust the invoice cost as follows. So let's assume we've got this invoice and we think about, oh, one of them was no good, we need to return it. Or maybe there was some sort of a discount offered for early payment. So whatever these things are, so we think about returns, we think about discounts, and we think about freight costs. Freight costs would add to the value of the merchandise inventory. You know, if it costs us $100 to ship that in, we'd add that to the cost of the inventory. So these are the things that we need to contemplate whenever we think about recording the journal entry for the receipt of products that are going to be sold. So let's assume in this particular instance that we had a case of a return. So the purchaser informs the supplier of any returns and allowances. This is often through written communication initiated by the purchaser to inform the supplier of a debit made to the supplier's account, including a reason for the return or allowance. So to illustrate how the buyers account for the allowance, we assume that the Roadster mountain bike purchased by LEC on November 2nd was discovered to be defective when received on November 5th. So there will be an entry there to take that bike out of inventory. So first of all, we're going to debit accounts payable, meaning that we're going to reduce the amount that we owe that company by $300. And we're also going to reduce the amount of our inventory by $300. So a reduction in inventory would be a credit for $300. So this entry effectively allows us to reduce our merchandise inventory and reduce our accounts payable. So what if we ended up with buying the product and the company that sold this product said, you pay early, we'll give you a good deal on this. So trade discounts are often used by manufacturers to encourage companies to pay earlier, to pay sooner. So because the list price is not intended to reflect the actual selling price of the merchandise, a buyer records the net amount of the list price minus the expected trade discount rather than accounting separately for the discount. So, for example, on November 2nd, LEC purchased clothing for resale from the North Place. It was listed at $2,000 in its catalog. LEC receives a 40% trade discount. The company records the transaction at $1,200 and $1,200. So merchandise inventory would be recorded at $1,200 and the accounts payable recorded at $1,200. Now the sticker price on the item then was $2,000. We got it for $1,200. So really, all we need to do is, from our point of view, as the person that's going to resell or the company that's going to resell that, is to just record it as $1,200, which is the historic cost. As I say, sometimes there's sales discounts too, and the sales discounts really come into play on larger items that companies, merchandisers provide. So sometimes we can avail of credit terms and discounts on credit terms of suppliers. Normally, these credit terms are stated in this type of format: 210 net 30. So this 2/10, N/30. This means that there will be a 2% discount if the bill is paid within 10 days, and the whole bill, the net, has to be paid in 30. So the dates are important here, and this is important for small business because small business want to take advantage of these discounts if possible, and you wouldn't want to ignore them. So in this particular instance, if we bought this, let's say on November 2nd, we would have 10 days then to pay that bill, so we'd have to have it paid by November 12th. And if we paid it by November 12th, we could take 2% off the bill. And we have to get it all paid by December 2nd. So let's see how we can record this if we take advantage of the merchandise discount. So in this case, the accounts payable would be reflected at $900. The merchandise inventory would be reduced by $18, and the cash would be reduced by $882. So effectively, we're paying our bill. The bill was for $900, so the accounts payable is effectively reduced or credited by $900, or debited, sorry. So the accounts payable is debited by $900. Merchandise inventory would be reflected in the change. Again, historic cost would be an important factor there. We'd reduce our merchandise inventory by 18, which is the amount of the discount, and cash would be reflected as how much we actually paid for the unit with the discount, which was $882. So these get reflected then in the various T accounts, such as merchandise inventory. You can see here, you can see after those transactions we've just done what the balance would be, and the accounts payable, you can see what the balance would be after that. The bikes are paid for, and the balance is 0. We also have to consider about shipping. And as I mentioned, shipping, it's often built into the cost of the product. And when we think about when we order something, usually the ordering is FOB, shipping point, or FOB, destination. FOB, shipping point, means that you are effectively going to pay the cost of transportation. And FOB, destination, really means that the seller is going to ship it right to you. And that's built into the cost. So we need to be able to record that. So in this particular instance, then, if we're going to be paying for the shipping, as I say, gets built into our merchandise inventory. So we have to pay $75 for shipping. The freight charge, we would add that to merchandise inventory. We debit merchandise inventory and credit cash. Similarly, we paid cash for the inventory. Now, one of the things with shipping is you have to be careful. This is from the purchasing point of view, okay, when you're buying inventory. So effectively, shipping costs get built into the cost of the inventory. This is not to be confused with shipping products to customers. So, for example, delivery charges and these sorts of things. That will be considered a delivery expense, and that will get reflected in our books as such. We've looked at the product coming in to us and how do we get it to enter it into our system. Now let's sell some of it. Let's go on the sell side. So here we are now, and we make a sale of this particular product. So we're going to sell these products. So like sold $2,400 merchandise on credit on November 3rd. So in this particular instance, then our accounts receivable gets debit. In other words, our accounts receivable went up, and our sales also went up. Now sales will be credited to reflect that. So we sold merchandise on credit. Now that just reflects the sale, but what about the cost of goods sold and the effect on our inventory? Well, we have to reflect the cost of goods sold. So we debit cost of goods sold for the actual cost of those products we sold, $1,600. And merchandise inventory would be drawn down. Our merchandise inventory is an asset, so crediting it would draw it down by $1,600. So what these two entries actually do is record the recognition of a accounts receivable, meaning that someone's going to be paying us money, record the sales, and record the cost of the goods that we actually sold, and record the fact that inventory reduced. And this is how perpetual inventory works. So if the customer, for example, makes a payment, and we look at it and say, well, in this particular instance, let's look into case one where the customer pays in 60 days. Well, the very fact that cash comes into the business from the customer means cash gets debited, and the accounts receivable, which is the recognition of the customer owes us money, gets reduced by the amount of the payment. If the customer pays in 10 days and we offer some sort of a discount, for example, a 20% discount, we are going to record cash, $980, meaning the customer only paid $980. Sales discount will be debited, and accounts receivable will be credited for $1,000. If there was a sales return, so let's assume we sold something and the customer brings it back to us, we're going to debit sales returns and allowance and credit accounts receivable. So the customer returns the merchandise effectively. And our merchandise inventory, if it's still available for resale, meaning the item was good enough to put back in inventory, we would increase our merchandise inventory by debiting it and credit cost of goods sold. And this would effectively return the merchandise to a saleable condition. Sales returns and allowances. Inventory returned is defective and can't be resold. In this particular instance, sales returns and allowances will be debited and accounts receivable would be credited. So the customer effectively would get their money back, or they would get the credit would be written up. So next we talk about adjustments. What are some of the adjustments that we need to make in the perpetual merchandise inventory system? Well, perpetual merchandise inventory systems keep a running total of inventory. We know that. And we got to record the sales and record the purchases. And periodic adjustments must be made to account for shrinkage. Every once in a while, the inventory goes down for some unknown reason. It gets stolen, it gets broken, it disappears, something happens, some form of loss. So in order to do that, what we need to do is we need to count our inventory. So we would, at the end of the period, we count our inventory and see if it matches what our perpetual system is saying. So in this particular example, the perpetual inventory system is saying there's $21.25 on the shelf. We count it, there's only $21,000 worth of stuff on the shelf, so there's $250 missing. That then would be considered as shrinkage. And in order to write that off, we just write it off the cost of goods sold. So we debit cost of goods sold and credit merchandise inventory. This would effectively get the inventory straight with the numbers and actual products on the shelves. Let's take a look at a sample demonstration problem here. Thorson Company trendy clothing retailer has the following transactions in March. They purchased merchandise from Sabine Company under the following terms: $1,800 invoice price, $215 net 60 terms, free on board factory. The cost of the merchandise to Sabine Company was $990. They paid a UBS shipping, $125, and they returned to Sabine unacceptable merchandise that had an invoice price of $300, and they sent a check to Sabine Company on March 2nd for all of this stuff. So what we're going to do is look at the journal entries for this. So first of all, if we look at the purchased merchandise, so it was $1,800 invoice price, $215 net 60, free on board factory. So in this particular instance, what we'd have to do is we would record the fact that there is an accounts payable set up. So the merchandise inventory goes up by $1,800, accounts payable goes up by $1,800. So debit merchandise inventory, credit accounts payable. Then there was a shipping charge for $125. So we'd again debit merchandise inventory for $125, and let's assume we paid cash $125. Then we actually paid the company, returned to Sabine unacceptable merchandise. So in this particular instance, our accounts payable is debited by $300 because it goes down by $300, and merchandise inventory goes down by $300 as well. And so effectively, we've reduced our accounts payable and reduced our inventory. And finally, we pay for the product. So in this particular instance, the accounts payable was $1,500, and we debit that, and we'd credit merchandise inventory for $30, which is the sales discount, and we would credit cash for $1,470. I invite you to review your textbook. There's a handy-dandy guide in there dealing with merchandise inventory journalizing and the various journal entries that we'd use for buying product for resale. So please take a look at that. Another big issue that we have is once we record all of those particular entries, we need to be able to come up with a way that we can report the financial performance of an organization at its period end, year end, month end, whatever. So how do we convert all of that? Well, let's do a little bit of a review here. First of all, let's look at the typical merchandising firm. And if you look at the bottom here, the merchandiser has sales. Those sales, we need to subtract the cost of the goods that were used in order to make those sales. That will give us gross profit. From gross profit, we subtract operational expenses, which are the related expenses to the sales, and that in turn will give us profit. So we need to present it in that sort of format. So usually the financial statements that get presented are of that type of nature. You'll notice there, as we move towards our year end, we get a trial balance. So we've seen our trial balance. This is the adjusted trial balance, and the numbers in the bold there represent the slight difference that you would find in a merchandising firm in terms of the extra accounts that would be added. So you see, for example, sales returns, sales discounts, cost of goods sold would show up in your trial balance, and that would get reflected in the income statement. So let's look at a couple of income statement formats. Typically, they come in two basic flavors. The first flavor is a multi-step statement. And a multi-step statement, what it does is effectively shows the breakout of the merchandise items that are going out of the firm. Okay? Now, this statement tends to be used more for an internal statement. So let's just take a look at it here. So what you're going to see, for example, is that sales are recorded at the top, less any of the discounts or returns. So we record what we have there, and that will give us net sales. From net sales, we subtract our cost of goods sold, and that will give us our gross profit. Now you'll notice in the operating expenses tend to be broken down into a couple different types: selling related expenses and general related expenses. So that's that's sort of the nature of this multi-step. So it basically breaks it out by the category. Other related things, so for example, this firm is mainly a merchandising firm, but let's assume that it has rent and it has interest. You'll notice that they're broken out in the bottom there, so you can see that revenue and expenses related to rent revenue and interest expense are not necessarily directly related to the business, so they're broken out as other revenues and expenses. We can also create a multi-step statement for external reporting, and really the only significant difference is it doesn't have as much detail. Okay, the multi-step statement takes the net sales, subtracts the cost of goods sold from that, generates a gross profit from sales, and then it details out the operating expenses. So you can see the related operating expenses, and then the profit from operations, and the other revenue that are not necessarily related, and other expenses that are not necessarily directly related to the operation of the firm. We can also come up with a single step format. Now this is the least preferred statement because it's not giving as much information, but it's more of a quick summary statement, okay? And all we have there is simple revenue and simple expenses providing the profit, bottom line. So you notice that net sales is the only thing recorded. So he's not breaking up cost of goods sold or anything like that. It's just the net sales. So the total sales less your cost of goods sold, that sort of thing would give you your net sales. So it's a simplified version for external users. And generally for external users, this is probably sufficient. And the final thing that we looked at in this chapter was this issue of analytical tools. Now, analytical tools are very important because as a company, at the end of the year, when you look at your financial statements, you're going to want to be able to say, are we doing well? Are we doing poorly? Are we doing as good as other companies in our field? Are we doing better? Are we doing worse? These sorts of things, so you can make some comparisons. So one of the key tools that is used in order to be able to do this analysis is something called the gross profit margin. Now, gross profit margin is really very simple. What you do is you take your net sales, subtract off the cost of the goods that you sold in those sales, and divide it by net sales. So that will kind of give you a sense of how much gross profit you're making in each dollar of sales, okay? So, for example, I'm making 20 cents on an item, or 100 cents on an item, $1 on an item, that sort of thing. So you'll notice that the advantage is when you compare year to year. So in the little leaks gross profit ratio here, you'll see, for example, you can compare year over year over year. So it was 26.8% in 2020, 28% in 2019, 29%. So you notice that gross profit is actually going down. So that's probably not a trend that we want to see. So we're going to have to look at that. We can also look at industry averages and say, where are we relative to the industry? So gross profit margin is a common tool that's used. And also, as a tool, we also look at markup. And markup is really getting an indication of how much extra we charge for something. So if we buy it for $1 and we sell it for $1.20, there's a 20-cent markup, which equates to, in the case of $1 item, a 20% markup. And we can calculate that as the selling price minus the cost over the cost, and that will give us a percentage. Most stores tend to have a percentage markup, 20%, 50%, whatever it is. It depends on the industry. And online you can go look and see various industries have standard markups in their operations. Okay, well, that covers the material in this chapter. I want you to take a look at the review questions. Thanks for taking the time to listen.